As I said, tonight we're looking at a collection of graphs that we've found thought-provoking during the last month. Maybe you have a graph you'd like to share with us, so please do forward that to wealthquest@abn360.com. Let's start off with what's caught Liang's eye, and certainly I don't think it's only Liang who has been focusing on US Treasury yields and the direction of them, certainly post the Fed's speech this week. Liang, but just talk to us about, firstly, your views on what's taking place in the US when it comes to the outlook for quantitative easing and how the market is interpreting the comments from Ben Bernanke.
Hi Sam. I think what we're seeing from Ben Bernanke is that he's looking to, should the economy strengthen in the US, he's looking to taper quantitative easing. So certainly slow that down and start not buying as much bond as previously is and looking to hike rates much further down the road. For myself, I think in the very, very short term, perhaps the market has gotten slightly ahead of itself, although I think overall they've gotten the direction right. Bond yields certainly are set to rise. I think to me they face two big headwinds. The first thing is the normalization of real rates, where we're going to go from an environment of negative real rates back into positive real rates. And secondly, I think should we see a bout of surprise inflation somewhere along the line, it will look very ugly for bonds.
Is that a risk that you even contemplate right now, the inflation concerns?
Not right now. So that's something certainly more down the line. Having said that, looking at historical time periods, what you've seen a similar period perhaps in the 70s, out of the 60s into 70, where they're going out of deflation into inflation. And speaking to people that lived through that period, the one thing that they commented on was a big surprise. They said somehow, at some point, all of a sudden, they were getting these massive real wage hikes. And they didn't complain about it. They just said, okay, that's great, we'll take it. And what happened was that caused quite a supply-side push inflation, in spite of perhaps even back then of a weak economy.
So let's get a look at your graph, because that's what this show is all about. We'll get it up on screen, but take us through essentially what it's showing us.
Sure, I think I'll start with quite a simple graph. So what the blue line shows is the 10-year yield of the US government bond. And below that I have the red line, which is the 10-year real returns going forward should you have bought the bonds at that point in time. What's immediately apparent from the chart is, I think, two things. Firstly, bonds are a very, very simple asset class. There's truly no secret to the return of bonds. If you buy the high yield, you get a good return. If you buy a low yield, you get a very bad return. Unfortunately, looking at where the blue line is right now, what this implies that investors buying bonds now going forward is likely to experience very negative real returns.
And I mean, look at the time frame again for the graph. Let's just put that graph up again. Look at the time frame for this graph, because Liang makes a very, very interesting point here. This graph actually goes back to 1962. And as a matter of fact, you see from 1962 all the way through to 1981, you can see how rates actually rise, yields actually rise in the US, and we've been on the slow dwindling curve all the way down to where we are at the moment. And at some point, there's a structural reverse as far as this is concerned. Now, most of the rule book, if you speak to asset managers and you talk to money managers and people that trade, they'll say, well, the rule book looks back 20, 30 years. If you use that rule book, you're probably going to be wrong, because we're seeing a structural shift starting to happen. You can see all the asset classes very jittery on the back end, and they're not quite sure what is going to happen and where you need to go.
Let's get into your graph, Cobie.
Well, I mean, I think it's actually first Roland's graph. Roland, why don't you take us
because this actually
through,
ties into what's taking place in emerging markets.
Absolutely. Why don't you take us a little bit through SA yields?
Yeah, just looking on the domestic side, we're sort of reaching an interesting point of resolve where if you take the South African real yield, in other words, the 10-year yield minus inflation, and the US real yield, you'll see that the light blue line is the South African equivalent of the US situation. And for the last few years, South Africa's had higher real yields than the US, and that's probably why we have seen, or at least some people argue, this is why we've seen such a strong bond market in South Africa, because foreigners are chasing our higher yield. That obviously comes with the assumption that we have a stable currency, which we have had, but that kind of situation is reversing itself now, and we're actually seeing that the real yield in South Africa is falling below potentially the US real yield, and people are going to say, why should we invest in the South African bond market if we can get higher yields elsewhere in a hard currency without the volatility?
Roland, maybe a question from my side. If you look at the real yield on the 10-year in South Africa, which is a 10-year bond, you're looking at about 130 basis points, about 1.3%. And if you look at a similar bond in the United States, you see that real yield at about 0.8%. That's obviously now relative to American inflation. Now, if you're seeing the structural shift and you're seeing yields rising in the United States, you're seeing bond outflows out of South Africa, potentially migrating back to the US, either flowing into equities or potentially into bonds. And if you've got economic growth, well, quite frankly, you've got CPI growth, and then you're going to just see that kind of trend continue. You're obviously on the back end of that going to obviously currency weakness.
Well, it's all about this quantitative easing, which is the big leverage in the background that's driving this. And if that starts to turn around or taper off, then people in emerging markets with the currency volatility we've seen are just going to say, never mind what bond markets are doing, it's just too volatile to have that kind of exposure. The second graph actually shows you the bond flows for South Africa. And the currency volatility. And it's quite interesting to see that negative relationship. So whenever we see currency volatility falling, as we have seen recently in that dark blue line, you will see that bonds have been, in other words, foreigners have been buying our bonds. There's been net bond inflows. Now, recently, the currency's obviously done a big turnaround, which you can't see on that graph, but that low volatility has now changed, and the currency is becoming more volatile, and that generally goes with bond outflows in South Africa.
Liang, let's just get your perspective right now on what's driving the South African bond market and how you see it playing out. Because if you look at the latest data point from CPI, or the CPI data point, it indicates that maybe inflation not as much of a problem as we thought it was. It's still below 6%, but do you see going forward that inflation is going to start eroding the yield in South Africa, and also what's taking place overseas is going to see foreigners looking at other potentially more attractive markets?
Samantha, I think if you look at our CPI numbers, that number is lagged, so that's backward looking, it's not forward looking. So the depreciation of the rand, especially the heavy depreciation we've seen in the last 2 months, that hasn't come through to CPI yet. Now, historically in South Africa, that always feeds through 6 months or 1 year ahead, right? So it'll be a very, very, I don't want to be a Reserve Bank governor at the moment, because can you imagine if you see that pressure coming through, we're having weak economic data still in South Africa. Certainly we're not growing at a very, very strong rate. In all likelihood, she might even be forced to hike rates in order to combat the outflow that we've seen. Now, you talked about foreign outflows. I don't want to sound alarmist, but if you look at the recent data, we've seen we've had an extreme move over the last month and a half in terms of bond moves. We're talking about 2% bond yield moves. And to put that in perspective, we took data from 1986, monthly data, right? There's about 320 odd data points we have. That would have ranked number 5 as the biggest monthly move that we've seen, the move in May. Overall, foreigners have only sold probably about 7 to 8 billion rand worth of bonds. Over the last 2 years, they bought over 70 billion a year.
So when we talk about, and just tying this into the government and our borrowing needs, is this, are we going to potentially be in a crisis point this year? Are we moving towards a situation that we could potentially be in a critical situation with regards to our funding requirements?
I think now it is very, very important for the South African government to really show leadership in industries and show leadership in terms of policy. I think we're susceptible to a crisis, right? We're not there. We're not in a crisis. Well, Rand moved around over a 1 month period, so perhaps we're in a crisis already. But it is absolutely crucial now for the South African government to really clamp down on the labor unrest that we've seen, to really come up with policies that are much more perhaps business-friendly, market-friendly, especially over the longer term, in order to halt that. Having said that, I think at some point we just need to have an attractive enough real yield so that people will still buy us.
So let's talk about the equity market. We spent some time talking about bonds. What about US equities?
Yeah, again, let me just tie up again here with what Liang has said and also what Roland has said. You've got something happening from an economic perspective globally. That has put pressure on the South African economy, and quite frankly, not just the South African economy, but other emerging markets. And then on the South African front, you've got this political overlay and social overlay as well, which is actually quite explosive if you think about it at the moment, predominantly because you're also leading into elections in the next 12 months, which might make for interesting reading when we look back on this time period, once we've actually lived through this. And on the back end of that, also take into consideration that your South African market is actually quite expensive relative to what you can still get globally. And just to show you what the market actually looks like overseas, here's the S&P 500. And this chart really is quite a nice chart because it actually shows you $100 invested in the S&P 500, that's now the red line. And a lot of people will talk about the fact that you had this magnificent crash on the American markets, and quite frankly, that's now reverted back to where you were before, and beyond this point now we need to get growth. But in real terms, if you look at the black line, and here they've rebased it back to 1982 and 1984, and they're using that as a CPI base, look what's happened in real terms. You can see that as far more muted as far as growth is concerned. And you can kind of see that flat top that's kind of that has been created over here. This over here obviously is great news if you're buying equities on the international scene, and in this case on the S&P 500, predominantly because you're buying these assets with a really low base still.
Yeah, we've just got around a minute left. Roland, do you want to add your voice to that comment there?
I think at this time you need to have some kind of protection in your investment strategy. In other words, it's too risky to take a fully exposed position to equity markets. So it's best to have exposure, but to try and manage your risk rather than try and beat the market.
Mm-hmm. Liang, do you agree with that?
I absolutely agree.
Yeah.
I think it's exactly that, where market has had quite a strong rally already. The US recovery, should it be, if QE ends but the US economy is stronger, there's room for equities to continue to rise. But it'll be interesting to see how businesses react to a much higher real rate environment compared to the past few years where they literally had free money to run around in.